This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
It is Bloomberg Businessweek Daily. It is Friday, August 28th, 2026, a Jackson Hole Fed Friday. That's Lisa Mateo. She's in for Carol Masser. Lisa, you can check her out on Bloomberg this weekend, 7 a.m. Saturday and Sunday. But she's hanging out with us on this Friday. Happy Jackson Hole Day.
And what a Friday.
I know. What a day, truly.
It is. All the talk is about that. The market reaction, that's what we're going to get to.
Yeah, Charlie Pellet's going to have an update on the numbers. Suffice it to say, though, the S&P 500 under a little bit of pressure, down 0.2%. Bond yields, though.
Yeah, that's where you see the difference. Look at the 2-year, 2.78%. That's higher. Wow, okay.
We're going to be covering it all in just a few minutes. As I said, Charlie's going to have an update on the markets. We are going to go to Jackson Hole, though, and talk to Mike McKee. He's out there in the shadow of the Tetons. If the sun is out, I don't know if the sun is out. He's going to have the latest from policymakers. I know. I feel so bad, as everyone knows. I mean, the Mountain West in the summer is just unbeatable. Yeah. So hopefully they got some sunshine a little later. On those yields, though, Brooke May is going to be stopping by of Evans May Wealth. She's going to talk about investor reaction and if there's any portfolio repositioning as a result of what we heard from the Fed chairman. Also, a couple of distinct views from executives a little later. We're going to get the executive chair of the Canadian auto parts manufacturer, Linamar. She's going to be joining us to talk about those U.S.-Canada tariffs.
Yeah, it'll be interesting to see how it's changing our business, but also what it's doing for U.S. manufacturers and the consumer, too. Are we going to pay higher prices for cars?
Speaking of the consumer, Max Levchin of Affirm is stopping by a little later this hour. That stock was up as much as 17% earlier in the session. It's given back a little bit of that, but we always like talking to Max for a view on what that consumer's doing with this buy now, pay later firm. All that and more coming up over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
All right, thank you very much, Tim and Lisa. Happy Friday. Not so happy for the bulls today. We're trading very close to session lows on the S&P 500 index, down 19 right now. It's 77.11, a drop there of just about 0.2%. We've got the Dow lower by 20 points. Little change, down under 0.1%, while NASDAQ down 119, drop there of 0.4%. The NASDAQ 100 index down by 0.7%. Marvell Technologies certainly weighing on the index after earnings. Marvell down now by 10%. Traders sent short-term yields higher as Fed Chair Kevin Warsh vowed to bring inflation to the target, boosting bets on a rate hike and also stabilizing longer-dated bonds. So here's where we stand. We've got the 2-year, 4.34%, the 10-year, 4.72%, the 30-year, 5.20%. Gold at $44.65 the ounce, spot gold down 2.9%, West Texas Intermediate crude at $83.35 a barrel, WTI down 0.2%, barrel of Brent now $89.36, drop there of 0.4%. Speaking of crude, Chevron is in talks to expand its operations in Venezuela as the Trump administration broadens its influence over the nation's oil sector. Now, sources tell Bloomberg Chevron is negotiating to add 2 new oil fields to its operations in Venezuela. They say other U.S. energy companies are also in discussions to make new investments in the country. So right now, among the oil supermajors, Chevron higher, up 0.9%, ExxonMobil lower by 0.5%, ConocoPhillips up by about 0.8%. Recapping, S&P does remain lower, down 0.2%, just about 2 hours to go ahead of the closing bell. The 2-year, 4.34%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, Lisa Mateo, and Tim Stenivek. That is a Bloomberg Business Flash.
All right. Thank you, Charlie Pellet. Let's get right to that speech. Okay, so it was his first speech. We're talking about Fed Chair Kevin Warsh. He warned about a couple things. Okay, so first he warned inflation isn't meaningfully slowing. He also stressed that policymakers are going to return inflation to that 2% goal. But here he was earlier. You want to listen to him. He was speaking at the Fed's annual conference in Jackson Hole, Wyoming. Take a listen.
We should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Achieving both sides of our mandate over the medium term is not an either-or proposition. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep.
Fed Chair Kevin Warsh earlier today, this morning from Jackson Hole, Wyoming. In Jackson Hole, Wyoming, we bring in Michael McKee, Bloomberg TV and Radio International Economics and Policy Correspondent. He joins us from a still rainy day, unfortunately, Mike. Hopefully when you're done talking to us over these next few hours, the sun will come out a little bit. In the meantime, I do want you to just give us some detail about what we learned new about the way that this Fed chair looks at the Federal Reserve's role and how he plans to bring inflation down.
Well, I think we learned a lot. The issue is, should we have learned it earlier? That's what Wall Street was complaining about. But he made it clear that he's looking at the data and that he is focusing on inflation. And one of the things he clued us into is he's not just looking at the level or the change on a month-to-month basis, but he's also looking at the breadth of inflation. How many components are going up? How many components are going down each month? And he noted that the number going up was 54% in the last month, which is more than half. So that told him that the economy still needed help, that inflation was still rising. So that gives the folks on Wall Street something to hang their hats on. They can look at the same indicators and infer from that, when we get new data, what the Fed might do. He made no promises about what they're going to do, but he did give them sort of a roadmap to how he's thinking about it, which is what they were asking for.
Yeah, so he did kind of say, if inflation isn't slowing, he said, we have work to do. He basically went out and said that. Do you think that he loses credibility if the Fed decides not to hike come September?
No, I think it's all going to depend on the data. He made it clear that at this point, the inflation rate is still too high, and it hasn't been moving in the right direction. And so if we don't see progress in the CPI and PPI reports coming up in 2 weeks, then there's probably going to be a market move to price in a rate hike. And if one didn't come, then he might lose some credibility, but he probably would follow through if it was pretty obvious that inflation's going in the wrong direction.
The Fed chair speech is a big part of the Jackson Hole Economic Symposium, Mike, but it's not just about the chairman of the Federal Reserve. I believe everybody from the Fed is there except for Jay Powell. What is the other chatter that's happening on the sidelines right now?
Well, the most important chatter is that it is raining here, so the hike that usually attracts most of the participants at this conference is likely going to be postponed, and I don't know what they're going to do with all of them. Maybe rent a Netflix movie or something. But beyond that, there's obviously questions about the topic of the conference itself, the symposium here, which is financial innovation in payment systems, which sounds very wonky, and it is, but for people who are in this business, it's important. And then there's a sort of undercurrent of, we're wondering what's going to happen with Lisa Cook. Is the president going to come out and try and fire her again? And is there going to be any drama on that score while we're here? And finally, a lot of central bankers aren't here this year from other countries because there's a G20 meeting in Asheville, North Carolina, starting on Sunday. And a lot of the finance ministers just went directly there. The Treasury folks will be there. And given what Scott Bessent has been doing and messing around with the bond market, there'll be a lot of focus on that as well.
I mentioned Jay Powell not being there. The reason that is of interest is because he is still a member of the Federal Reserve, and he has not stepped down. I'm curious if that is at all part of the conversation or what we need to know about him not being there.
No, I don't think so. it's certainly noted by everybody, and I think everyone agrees here that it would have been very awkward for him to show up. It's very, very unusual for a former chairman to stay on the board. He has good reasons for doing so with all of the Donald Trump stuff, but he doesn't want to take the spotlight away from Kevin Warsh, and he certainly wouldn't want to do it for Warsh's maiden speech, because as Warsh were speaking, everybody would be looking at Jay Powell. So he made the decision to stay home, and nobody's begrudging him that at all.
All right, Mike, I have one more question before we let you go. I know you've been talking about all the things that Warsh did say and everything he did, but is there anything that he did not touch upon that you were thinking, well, maybe he would have? What did he not talk about?
You know, I don't think there was anything in particular that he didn't talk about. He touched on a lot of the issues that he's been talking about for quite a while: the Fed reforms, the 5 task forces, the idea that the Fed wants to develop an up-to-date measure of inflation. He didn't say they wanted the trim mean or anything like that, but he wanted it to be updated and modernized. And those are all themes he's been hitting. What had been missing is how is he going to attack inflation given the tools that he has, and he did come through with that today.
Mike McKee, Bloomberg Television and Radio, International Economics and Business and Economics and Policy Correspondent out there in Jackson Hole. He is going to be joining us just a little later in our program at the top of the 3 o'clock for some updates from the Mountain West. Well, we do stay on Jackson Hole, not necessarily in Jackson Hole, because that is what traders and investors are focusing on today. For more on policy, we're joined by Brooke May, managing partner at Evans May Wealth. She joins us from Carmel, Indiana. Brooke, good to have you back on the program. You know, we saw what happened to bond yields today, especially at the front end. We're seeing some pressure on tech stocks over concerns about rates moving higher. Are you making any changes to client portfolios as a result of what you heard from the Fed chair today?
Good afternoon, Tim. You know, right now we're not making any changes. We're going to be in a wait and see. Right now, we're pricing in about a 60% probability of a rate hike in September, and even higher probability of a rate hike before year end. So it's not imminent at this point. Odds went up today based on Warsh's comments. However, I think that we've got a lot of good momentum across the market, not only in large cap, but also in small cap and international. And so I think that you can continue to be an equity investor. However, certain areas of the market that are a little bit more interest rate sensitive, those that rely on debt, like small cap, 40 to 50% of the debt small cap companies have is floating rate. So it's something to watch. If we do get a rate hike, I think that paring back certain areas would be warranted.
Brooke, I have to ask you, Warsh reiterated that policymakers are going to return inflation to that 2% goal. After hearing everything he said, I mean, are you convinced?
No.
That was quick. We need more from you, Brooke. This is TV and radio.
You know, I think that, you know, it's hard to move rates. You know, if it was easy to get there, we would have been there by now. We've been battling inflation now for several years. The fact that we've got now labor market stability is nice. However, I don't know that we've really made it much in the way of progress, especially with what's going on in the Middle East. Oil prices are playing a role, and it's rippling through to the rest of the economy. And so until we see resolution there, I don't know that we're going to see a meaningful decline in interest rates. So yes, ideally we will get there. We might end up settling around 2.5% instead of the 2%. That would be ideal. But you know, Warsh did indicate that inflation is a concern and that they've got work to do.
Is it a concern until there is a total resolution out of the Middle East?
Yeah, I think so. I think that, you know, we're going to continue to have uncertainty. And we've seen that. If you look at gold and Bitcoin, there's concern right now around the debasement of the dollar and what that would do for purchasing power. And rates are going to stay elevated if inflation is elevated. And so I think it's going to continue to be a concern as long as we've got uncertainty in the Middle East.
All right, Brooke, I want to switch over to tech and to AI and to that trade. Got to talk about the NASDAQ. It was lower before. It's still lower now. Then we go to NVIDIA shares. NVIDIA shares right now, they're down about 4%. So quite a difference from what we've seen, right? NVIDIA added $442 billion to its market value on Thursday. All this said, I mean, what is that telling you?
Mm-hmm. Earnings are strong, and the AI trend is real. When we look at NVIDIA, they're expecting to have 72 to 73% profit margins next year. That's incredible for a company their size that's growing at the pace that they are. And it says they've got pricing power, they've got demand, and they're broadening their customer base. There's been a lot of publicity around circular financing and some of the debt instruments that are going to be out there to allow them to serve more customers. So not just the hyperscalers, but now the neoclouds and other customers. So we think that demand is real and that we're going to see AI-related earnings continue to be very strong for a prolonged period of time.
So what's your take on why you think the shares are lower? Sorry, I didn't mean to jump on you.
Oh, no, that's right. They, we had such a surge after their earnings announcement. I think that there's probably a little bit of profit taking there. I don't think that there's anything systemic that's a concern right now. It could be somewhat interest rate related, but I think the overall momentum is very strong and earnings are going to be very strong going into 2027.
Yeah, I mean, we're at the tail end of third quarter earnings season, or second quarter, I should say. We're into the third quarter. We'll start to hear from some of the big companies in the beginning of October. Given that we heard from the Fed chair today, NVIDIA is behind us. We have a policy meeting in the middle of next month. Between now and then, what is the next catalyst that we should be on the lookout for?
I think it'll be midterm elections.
Really?
And
you're already looking to November.
Yeah, there's not a lot. There's not a lot between now and then. It tends to be the unforeseen that gets you. But really on the horizon right now would be midterm elections and what potential policy initiatives could come about through the results.
And Brooke, where do you think the next wave of investors will come from?
Can you say that again?
Where do you think the next wave of investors will come from? Because we've been talking about AI and tech, and where's the next wave come from?
I think the cash on the sidelines. There's a lot of FOMO out there. A lot of people have missed this rally, and there's $7 trillion right now in cash and money markets on the sidelines. That money, at some point will be redeployed into the market, and those that have been waiting for a pullback have really missed out. So I think that continued good earnings momentum will push some of that cash into the market, and that could be another catalyst for a leg up.
That cash pile, though, Brooke, has just grown over the last 6 years. And I'm wondering, we've been waiting for it to get on the sidelines. Does it keep growing or does it eventually deplete?
In the near term, it could keep growing, but I do think that there's tremendous opportunity with earnings being this strong to get a better return for investors. And so I wouldn't expect it to grow at the same pace that it has. It's frankly shocking that it's grown to the level that it's at right now.
Yeah, it's remarkable. I mean, every time we see another $1 trillion added to it, I'm just like, where is this cash coming from, and why is it not being deployed in either the equity market or the bond market? Hey, we only have 30 seconds left. On the fixed income side, what is attractive to you?
Mm-hmm. We continue to like investment grade, as well as right now you could buy high yield. We don't think there's a lot of systemic risk right now in the system, and we think that you can pick up a little bit more yield without taking a tremendous amount of risk.
Brooke May, managing partner over at Evans May Wealth, joining us from Carmel, Indiana. It is a Friday. It's a Federal Reserve Jackson Hole Friday. We're talking about what happened out of Jackson Hole, but also what's happening in equity markets, where the S&P 500 is down close to 0.3%. The NASDAQ right now down 0.5 percentage point. But if I look at what's happened over the last 5 days, we're up 0.5 percentage point on the S&P 500. Big reason why is what happened with NVIDIA yesterday. Like you said, more than $400 billion added.
It's a lot.
It is a lot. Hey, coming up next on Bloomberg Businessweek Daily, switching gears a little bit, we're talking about tensions between the U.S. and Canada. That's next on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A lot of red on the screen today. It's a Fed Friday. Kevin Warsh speaking at Jackson Hole. Been all over it here at Bloomberg. We will continue to have further coverage, further reaction. But right now, looking at the equity market, traders sending stocks down. S&P down 18. Now it's 77.12. That is a drop of 0.2%. Dow Industrials down 28. Little change, down under 0.1%. NASDAQ is down 123. A drop there of 5%. 0.5%. The NASDAQ 100 index down 0.7, certainly weighing on that index. Shares of Marvell Technology after earnings plunging now by 10%. The SOX, the Philadelphia Stock Exchange's semiconductor index down 3.2%. The 2-year right now, we've got short-term yields. The 2-year 4.34%, the 10-year 4.72%, the 30-year 5.20%. Gold is at $44.62 the ounce, lower by 3% today. Right now, West Texas Intermediate crude has been bouncing around, but down under 0.1%. 83.45 as traders keep an eye on developments out of the Middle East. Barrel of Brent, the global benchmark, now very close to 89 a barrel, down by 0.4%. BioNTech and Roche Holding have abandoned a trial of a personalized cancer vaccine, dashing hopes that had been raised by a rival drug maker's recent successes in the field. BioNTech says the German drug maker and its Swiss pharma partner made the decision after an independent board recommended discontinuing the trial. BioNTech shares, the ADRs right now, they're down 7.7%. ADRs of Roche Holding down by 1.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Lisa and Tim, that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie. Do appreciate it. Let's talk trade, because Canada will place counter tariffs on more than 700 products made in the U.S. as retaliation for a new set of import taxes by the White House. We did see earlier this week the news hit some U.S. and Canadian stocks, including automotive auto parts stocks. Among them was Linamar, the roughly $4 billion U.S. dollar market cap maker of components used in the automotive, defense, and aerospace industry. Think engines, transmission, suspension, components, and more. Shares of the company fell more than 8% on Monday, down this week by about 10%. That said, still up about 18% this year, and going into, the last 10 days or so before that, they were up more than 25% this year. We've got with us Linda Hasenfratz. She's Linamar Executive Chair. She joins us from Guelph, Ontario. Linda, good to have you on the program. I want to get a firm understanding from you about what is and what is not subject to not just tariffs currently, but potential tariffs come the beginning of next year.
Well, from Linamar's perspective, more than 90% of our sales have absolutely no tariff on them this year. And that has been the case for some time. So we are being impacted a little bit on that less than 10% of our sales that has a tariff, but the vast majority of sales do not have a tariff. And even this latest round of tariffs, the 338 tariffs that were enacted last week, do not impact our industry. The retaliatory tariffs, we also believe, will not be impacting us due to exemptions that are in place for manufacturing in certain sectors. So we feel we're in as good a position as we could be at the moment.
What about tariffs on actually cars and trucks, because that's the end product for what your products go and build. And I'm curious if this hits your customers, then that certainly affects your business in a certain way. So are there knock-on effects, even if your specific products aren't affected, but the end product is?
Yeah, I mean, obviously, if our customers are being impacted by tariffs, that has a negative long-term impact on pricing, because nobody can absorb tariffs forever. So in the end, it all ends up flowing down to the consumer, which is not a good thing, right? If consumer prices go up for vehicles, then that could negatively impact demand and result in lower production in the industry. So that's obviously a threat for the overall industry, even if the parts suppliers are not seeing tariffs.
Again, just to clarify, because there are a lot of moving parts and there's a lot of back and forth between the U.S. and Canada here. We did hear earlier this week from the President of the United States, who said that on January 1st, 2027, tariffs on all cars, trucks, both large and small, automotive parts and steel will be increased 50%. Does that increase to 50%? Will that, if there is not an agreement reached between now and the end of the year, will those tariffs affect your company?
Yeah, I mean, up until the moment and until this latest potential tariff, there has been no tariff on auto parts. So if a tariff is imposed on auto parts as of January, it will obviously have a big impact on the industry. I mean, the industry is incredibly integrated from a supply chain perspective across really all three countries, not just Canada and the US, but also Mexico. But I mean, just Canada and the US, I mean, we've had free trade in automotive with the US since the mid 1960s. I mean, this is decades and decades of supply chain integration. So parts are going back and forth over the border 6, 7, or more times. To incur a tariff at each border crossing will cripple the industry. It'll bring it to its knees. So, I mean, I understand it's a powerful threat that the president is bringing to bear, but the negative impact to the industry, the vast majority of which, of employment of which is in the United States, will be very negatively impacted. So I think that certainly the U.S. administration is going to need to give very careful consideration before they decide to impose such tariffs, just because of the blowback on their own country and their own businesses and workers.
So at what point would tariffs affect production on your end? What's your take on that after all we've been talking about, all we've been hearing you talk about?
Yeah, if tariffs are imposed on auto parts, and this is a position I've held for since tariffs first started to be bandied about, at the beginning of this administration, it would be a matter of weeks before the industry would be on its knees. In my opinion, it would shut down within a matter of weeks.
Wow.
Have you heard anything from companies, the automaker, the car companies? Have you heard anything from them? Are they thinking of changing plans? Have you heard anything?
Absolutely not. Okay. I mean, our type of product in our industry are highly engineered products. They're products that you spend years tooling up and getting qualified for with your customers. Significant amounts of testing required to make sure that they're meeting requirements around safety, around performance, around a whole variety of aspects. So this isn't something you can say, oh, I'm going to buy this transmission component or driveline component from somebody else tomorrow. Just not possible. This is a multi-year endeavor. So we've heard nothing at the moment. I mean, this is a very newly suggested threat that has been thrown out there. I personally think that we will come to an agreement before then. I mean, I think we were very close last week. There were, a few wrenches thrown in the works at the last minute. I have a lot of confidence that we will come to an agreement before the end of the year, simply because we are so reliant on each other. Americans on Canadians, Canadians on Americans. We have decades, frankly, centuries of interaction and commerce that we have done together. There's just too much at stake to not find a way to address concerns that either country might have with the trade relationship. I firmly believe that solutions are available and will be reached before the end of the year.
Yeah, we hear what you're saying, Linda, from lawmakers too, governors in states that border Canada and governors that do understand the importance of the relationship between the U.S. and Canada. We're speaking with Linda Hasenfratz, the executive chair of the auto parts supplier Linamar. She joins us from Guelph, Ontario. Among your biggest customers, Ford Motor, General Motors, Volkswagen, Stellantis, Mercedes-Benz. I mean, you sell that to everybody at this point. When we talk to executives at many different types of companies, what they tell us about this environment is it's less about the actual back and forth when it comes to trade policy, and more about the instability of an environment where it seems like rules and regulations can change very quickly. As executive chair at Linamar, what do you want to see, not just from the Canadian government, but from the U.S. government as well, just to make it easier for you to do business? Well,
I mean, I obviously would love to see us come to a resolution between our countries. Also with respect to the USMCA agreement and any changes that are being considered in that regard to see that agreement further strengthened. I mean, it is already a very robust agreement that is working exceptionally well for all three countries. So anything we can do to make that stronger would be great. But frankly, to think that we can operate, that we're going to suddenly go back to operating in this more predictable world, that just might not happen. I think that from our perspective, from my perspective and our executive team, our focus is how do we operate? How do we continue to operate and thrive in a dynamic environment? Because I think things are going to be dynamic for a while. So, things aren't predictable, and we need to develop strategies that are flexible, that are nimble, equipment that's flexible, people that are flexible in their capabilities, so we can pivot where the markets are going and take advantage of opportunities, frankly, that are created when there is, uncertainty and turmoil around you. That's been our focus, not a hope that we're somehow going to go back to some level of predictability, but instead, let's adopt a strategy. And I feel like we absolutely have a culture that's well suited to handling a dynamic, volatile environment, so that we can, instead of worrying about where things are going, simply react to opportunities as they present, and be positioned strategically and in terms of how we're structured to be able to take advantage of that. I think that's what companies that are going to thrive over the next decade need to do: be flexible, be nimble, be innovative, focus on your balance sheet, and be commercially astute.
All right, Linda, in the last 30 seconds we have, I'm going to put you on the spot. If you could sit down with President Trump and Prime Minister Carney, what would you tell them that they are thinking wrong about the North American auto market? What are they? How are they not thinking about it the right way?
Well, I think number one, the Canada-U.S. trade relationship is not broken. I mean, when you look at Canada exports $450 billion worth of goods to the U.S. exports $425 billion of product into Canada. Like, we have a balanced trading relationship. This is not the problem. Let's identify what are the irritants. Let's fix them. Let's keep working together, because it's a big world out there, and we're a lot stronger when we approach it together than we try to do so in a fragmented way.
Linda Hasenfratz, Linamar Executive Chair, joining us from Guelph, Ontario. Linda, thanks so much. Appreciate it. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. U.S. equities continue to trade near the worst level of the day, with the S&P 500 index down now by just about 21 points, lower by 0.3%. Two-year yields are jumping. The Dow down 25, drop there of under 0.1%. NASDAQ lower by 0.5%. NASDAQ 100 index down 0.7%. PayPal and Marvell Technologies certainly weighing on that index. Marvell, by the way, after earnings, down now by 10.3%. The SOX, the Philadelphia Stock Exchange's semiconductor index, down 3.2%. The two-year 4.34%, the 10-year 4.72%, and the 30-year 5.21%. Spot gold is down 3.1%, $44.54 the ounce. West Texas Intermediate crude now down 0.4%, $83.24 a barrel. Brent crude $89.37 barrel of Brent, down by about 0.4%. Bottom line here, traders sending short-term yields higher as Fed Chair Kevin Warsh vows to bring inflation to its target. Again, we've got the 10-year at 4.72%. Keeping an eye on Gap shares, certainly bouncing higher by 13.2% right now. Gap jumping after naming Michael Francis to head Old Navy, and also it reported that profit outpaced estimates, offsetting a sales decline at the Old Navy chain, along with lower sales guidance. Again, Gap shares, they are higher by 13.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Lisa and Tim, that is a Bloomberg Business Flash.
Charlie, appreciate the update. I'm watching shares of Affirm. They jumped as much as 17% in trading to the highest intraday going back to September of 2025. This after the fintech company forecast revenue for the first quarter that beat the average analyst estimate. Shares now higher by about 2.4%, so giving up some of those gains. Separately, the company and Shopify expanded their global partnership to launch Shop Pay installments in Australia. We got with us Max Levchin. He's the CEO of Affirm. He joins us from our San Francisco bureau. Max, welcome back to Bloomberg Businessweek Daily. Always good to see you. We're going to get to the results, but before that, I want to talk about the consumer because you have this great real-time view using what many people would argue is, crucial alternative data to understand the view of the consumer. How would you describe the American consumer right now?
I think the Affirm consumer, the ones we interact with all the time and see, is healthy. They are paying us back on time. They are shopping. They are taking advantage of the 0% deals that we also offer them. So all those things are still going swimmingly. I think it's impossible to ignore that gas prices are elevated for them, just like anyone else. I think inflation, as you just heard Chairman of the Federal Reserve tell us, is still stubbornly sticking above its target. I think they are stretching their budgets when they need to do it. And frankly, that actually accretes to the demand for Affirm. So in some ways, we are asked by our consumers to step up to the plate and help them manage their family budgets more often in the current environment. But by and large, they are healthy.
But what are they buying? Are they buying these high expensive items, or are they using this program to buy things like, to pay for utility bills, to do things like that? What are they buying, and what are they using it for?
Again, in our portfolio, by far, we are called upon to finance homewares, sporting equipment. There's a lot of back-to-school expenses that families incur right now, so everybody's buying something for their kids if those are going back to school. So that's the bread and butter of Affirm, and it has been for a very long time. Generally speaking, we are not huge fans of financing recurrent transactions and take steps to make sure our consumers don't give themselves a false sense of security by stretching something that is a subscription into a longer subscription. That's not a financially healthy decision. As you know, we don't charge late fees specifically so we can align ourselves with our borrowers. When they borrow without a clear plan to pay us back, we will just lose money. And so we routinely orient our models to decline applications for loans that imply sort of pushing off of the financial responsibility. We love our consumers to be financially responsible. We are here to help them be so.
Are you noticing any changes in the rate of declines when somebody's applying to use Affirm?
The rate of decline is something that we set. In fact, if you sort of wanted to do a super short crash course on how Affirm works, we set an acceptable loss rate for us, given macroeconomic signals that we get to see. That dictates the rate of approval, rate of decline, as a function, of course, of the credit quality.
So it doesn't change based on the individual who is applying for it?
No, it absolutely changes. What I'm saying is that we work backwards from the question you posed. We decide what our acceptable loss rate will look like, and that in turn sets or dictates what the approval rates will be. If you want to sort of take a very macro view of our position relative to the credit application set that we see every day, we're probably slightly more restrictive than we were this time last year, but again, nothing dramatic.
So how do you compare to the competition out there? There's Klarna, there's other ways. There's traditional credit cards as well. I mean, what sets you apart from that?
Well, first of all, I think our results do set us apart. I don't want to throw shade at anyone, but I think we've grown 30+% for the last 11 quarters, if memory serves. And for 12 months, we've been consistently GAAP profitable and many other accolades. And we may be the only ones in the space that have been able to print these consistent results while growing really quickly while remaining profitable. So at least we are a really well-managed company, I would argue. In terms of why merchants and consumers choose us much more frequently, I would argue, than our competitors, twofold. One, we in fact add a lot of volume to our merchant partners while always making them look great. We don't charge late fees, we don't compound interest, we don't do deferred interest. We are extremely transparent to our borrowers what the cost will be, and we reward them for paying on time and even paying early, which is quite different from traditional financial services. So merchants love us because we make them look great while making them more affordable. Consumers love us because we are so transparent, because we create pockets of access to credit for them in a way that isn't just transparent, it's also responsible, and they know it. We make it our business to make sure they understand that when we tell them no, it's not because we're finicky, but because we genuinely believe it's a bad idea for them to borrow more than they can afford to pay back. And most of them really appreciate that. And so I think we're quite different. We're a different breed, and the DNA of the company is in underwriting and precision and transparency and, frankly, quality. So that's what's driven our success in this market and beyond.
Perhaps one way you could differentiate from the competition would be to get a bank charter. You applied for a bank charter earlier this year. Can you give us the status of that application?
It's in process. It's exactly the sort of thing that you're not done until you are. It's a very, very rigorous process that the regulators make sure you have to go through without any shortcuts, and we certainly appreciate that. So I can't tell you very much about the state of the process. It is ongoing, but it's a thing that we don't require to operate, but we certainly would absolutely welcome being members of that particular club. It certainly helps clarify our exact regulatory status, and over time it will feed into our cost of funds as Bank of Affirm, should it be granted, over time becomes a source of funding for our loan portfolio.
So if you don't get it, it's fine?
Yeah, but we certainly hope to get it.
Okay. Do you think you will get it?
I think I will report back if and when we do.
Fair enough.
You're trying, Tim. You're trying, and I love it.
We all do our jobs.
Yes, exactly. Max, I got to say, you've been doing, the company has been doing very well with e-commerce. What's your strategy for in-store spending?
I'm a huge believer in the relevance of Affirm in store. It's actually something that I am personally very focused on. We just announced this very minor reorg, but allowing me personally to spend more time inside our innovation lab called ZT1, 0 to 1. And one of the many projects we're working on is making Affirm in store even better than we've been online. Online, we add 30% more volume through better conversion, through access to credit to consumers. Offline, we do more or less the same, but the participation in the offline world for us right now is quite de minimis, other than our Affirm card. So we're going to invest heavily in making the card even better, even more rewarding. But we also have some really clever ideas on how to make the in-store experience just a standout great thing. I don't want to front run anything, but if you can't tell, I'm very excited about what we're going to do in store. So watch this space. Ask me again in a quarter, and I'll show some real results, I think.
Well, are you also excited about? I think it was last September you allowed users to put the card on Apple Pay. How is that coming along?
It's great. We love all of our digital wallet partners. It's just another way of bringing Affirm with you in store. We're seeing really healthy growth, not just through the plastic taps and swipes, but also through digital wallets, online and offline. But offline in particular is just such a big unlock. And so we're doing really well there and quite excited to do more.
Max Levchin. Max, always good to check in with you. Appreciate you taking the time on this Friday afternoon. Max is the CEO of Affirm, and he joins us from our San Francisco bureau. Taking a look at markets on this Friday afternoon with just a little over an hour to go until the close of equity trading. We're seeing some pressure on tech stocks, perhaps concern over higher rates in the short term. The S&P down 0.3%, the NASDAQ composite down 0.6%. When we come back, a check of stocks on the move. It's Bloomberg Businessweek Daily.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek on Bloomberg Radio and Television.
It is Bloomberg Businessweek Daily on this Friday afternoon, a Jackson Hole Fed Day. That is not Carol Masser, that's Lisa Mateo. She's news anchor on Bloomberg this weekend, 7 a.m. Wall Street time on Bloomberg Television and Bloomberg Radio. Lisa hanging out with us, although apparently not next week as well.
No, just for today. That's it.
That's what you think.
Today's not my Friday. Today's my Wednesday.
Today is your Wednesday. Yeah, you do have a busy weekend coming up. We're looking forward to a great program over the next couple of days on Bloomberg this weekend. Before we get there, though, we still have to look at what's happening in today's markets. The S&P down just about 0.4%. The NASDAQ composite down 0.7%. The Dow under a little bit of pressure, down 0.1%. Let's take a look at some stocks on the move today. I'm Tim Stenivek with Lisa Mateo. We're joined by Bloomberg News Markets Live strategist Tatiana Darye. Hey, Tatiana. How you doing?
Good to be here.
So what do you got for us?
I'll start with PayPal, the big mover off at the day, down 12% after buyout firm Advent and payment processor Stripe decided to abandon its pursuit of the firm. Obviously, the big story today, that deal would have been one of the largest buyout deals in history with an offer of more than $50 billion. That's how it would have translated for its overall valuation. And PayPal said that was insufficient. And it's worth noting that it has been trading at a market cap of about $40 billion just before Bloomberg broke that story back in February that Stripe had an interest in the story. And obviously, that bid has been a source of support for the stock. Well, obviously, now it's a source of its weakness. Nonetheless, analysts here still see PayPal as a potential attractive target as valuation has cheapened over the years a lot.
Wow, that would have been a big deal. Affirm, we just had the CEO we were just speaking
Who's
with.
a member of the PayPal Mafia. He was one of the early PayPal executives. So
Look at that.
There's always a PayPal connection.
Great, that's the connection there. Well, Affirm shares up about 4%, was up about 17 earlier, the most in the year. This is all after an upbeat revenue forecast for the first quarter. The FinCap company is doing pretty well. It has guided for about $1.2 billion versus estimates of $1.17 billion. Yes, we care what follows the decimal point here, but it has also posted huge earnings growth. Four-quarter EPS, $4.62 versus 20 cents year over year. I had to double check this. This is huge growth. I can't even do the math here of how big the growth is. Revenue over $1 billion, also higher by 30% year over year. And you just have to ask yourself, what does this all mean by the consumer? Obviously, the buy now, pay later platforms seem to be very, very popular. But as a macro strategist, I always try to dissect what is the macro message here. The CEO would probably not like me looking into that as a signal about the health of the consumer. But nonetheless, you have to ask yourself that question.
Yeah, he did just tell us that that the Affirm customer is healthy, his customer. He always, because we talk to him a lot, and he's always very specific about the customer that he sees, that Affirm
it makes
customer.
Sense. Yeah.
And he says it's healthy, though. He says the company is slightly more restrictive than it was a year ago. Okay, that's Affirm. What else you got for us?
And BioNTech ADRs, that's the German biotech firm known for its COVID-19 shot that developed with Pfizer, down about 8%, was down as much as 18 earlier. That's after it terminated an advanced trial with Roche that it was developing for a personalized mRNA cancer vaccine. And this is a real setback, especially after hopes have risen after those blowout results from Merck with Moderna on the melanoma, and that they found really great results, and it raised hopes about the mRNA's second act here after COVID. Well, now this is raising real questions about, can this technology work in other tumors, particularly solid tumors, which other companies, including Moderna, are working on, and that's putting pressure on that stock as well.
I mean, it would be remarkable to just see
real progress, but not linear, right?
Yeah, exactly.
It comes with setbacks as well. So we'll see what mRNA has in store for us.
All right, that's BioNTech. The US ADRs, remind us of the ticker for that one?
It's BTNX.
BTNX for BioNTech. That's Tatiana Dare. She's Markets Live strategist for Bloomberg News with today's Stock Movers. For more conversations like this, check out our Stock Movers podcast, 5-minute episodes on the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts. Tatiana is sticking with us because she's got a great column out about yields moving higher, and that's exactly what they're doing today.
Yeah, that's exactly, and that is spooking stocks, right? We're seeing a little bit of the pressure, and every time we come back to the story, every time the 10-year or the 30-year is pushing higher to sort of cycle highs, or on the 10-year we are approaching 2025 highs, and perhaps soon, the 5% threshold, which is really, really scary for the market. But in fact, one has to look at history and realize that the levels alone is not the real danger for stocks. What is troublesome is when yields actually spike and when they go high fast, when there's this major shift in the cost of capital, that's the uncertainty that really troubles equity investors, not so much the levels alone, because for anyone fixating on levels alone, it's worth just looking back at the 1990s era, right? The internet revolution, when we saw growth really, really robust and really offsetting the drag from the higher discount rates used in valuations, which is what's pressuring stocks.
Speed of the increase. Who knew?
Tatiana Dare knows, and that's why
it.
she writes about it and tells us here on Bloomberg Businessweek Daily. She's Markets Live strategist. Check out MLIV Go on the Bloomberg terminal for that Markets Live blog and Tatiana's work along with her colleagues. If you're watching on TV, the close starts now. Radio continues.